Allow me to take you back to the basics. In this video, we want to talk about the investment process, some of the key steps in the top-down process. This is top-down, so you go in a kind of streaming fashion, in a linear fashion. You start with the asset allocation. Asset allocation is defining the asset that you want to put your money in, right? Whether it's going to be stocks or bonds, or it's going to be real estate, or it's going to be gold, it's going to be cryptos, right? All so deciding, or you want to be across the board, you want to diversify, right? So that's the step number one in case of top down, right? The second one, once you define that asset class, whether it's derivative or bonds or stocks, then you go and find a specific security, right? Security selection. And security selection, so the step 2 and step 3, I would say, are kind of interchangeable, or there is a lot of overlapping, right? You start picking up of security is based on what is called security analysis, which means you do valuation. You have to value the company, and for that, and to become good at that, there is no shortcut. You have to, I said it earlier also, you have to be able to read the financial accounting numbers, right? Accounting numbers. Now, accounting numbers come in a certain format, and they are not always very helpful in doing the valuation, and therefore there is a need to change or convert them into, it's almost like a language conversion, right? You convert them into financial language. And the reason I mean is accounting book, as we talked earlier, it tends to be backward looking. It tend to have the historical focus, whereas the finance is always about the future. And therefore, there is a little bit of lost in translation thing that's going on, and you want to bridge that gap. And that happens through the step 2 and 3. You do the security analysis, you find the value of the company, and by dividing with the numbers of stocks outstanding, you get the price or the value per share. Now, that value per share may be lower than the current price, or it would be higher than the current price. And based on that analysis, you realize that, okay, because the value per share is higher than the price, I should buy it. It's a straightforward decision mechanism as far as long as you believe in the valuation that you've done. And I always say valuation is very, very subjective. And we all, let's say all of us in this class, we go out and value the same company. One company we pick and we value individually. And I can bet that we will all have different numbers at the end of the day. So the question is, yes, you do your valuation, but you don't live in your own bubble. You go out, and these days it's become so easy actually to check your valuation. Now, I'm not going to go into the details of the nitty-gritties of valuation. It's a course onto itself. It is, but the thing that I'm talking about, it's called intrinsic valuation, where you actually look at the cash flows, and you basically, based on the cash flow, on the basis of cash flows, you develop the idea that what the value of this company is going to be, which means how much value it's going to generate through its lifetime. So there are a lot of assumptions, a lot of things that go, but roughly it is a very straightforward, simple process, but it can be dragged up or dragged down by your assumptions. So you may make wrong assumptions, and sometimes you may wonder, why should I trust my own view, and on the basis of that I should put my money? Don't do that. What you can do instead is you can put your numbers first. You come out with it. Don't look around. Just come up with your own value of that company, and then you can start looking around. You've got a lot of peers who are sharing their prices and valuations that they come up with about many, many asset classes. So when I say value and price, there is a difference. We made that difference clear. Price is based on, it's a random thing. It's based on demand and supply, and supply and demand could be based on behavior, right? It may not be based on the intrinsic value, and that's where the valuation comes in, right? So you correct your assumptions on the basis of what you hear. And in order to figure out what kind of ecosystem you should be, so that you actually get the right, you hear the right voices, not the noises, make sure you figure out who are the important people vis-a-vis that company, right? And a lot of people, a lot of hedge fund guys, they put out their blogs. There are a lot of blogs running for a really long time, focusing on a few companies, right? So if you follow these blogs only, let's say you're interested in Tesla, and you'll find about 100 really high quality blogs, and you can decide maybe 10, 15 of them you want to go with them because they've been right? Historically, you can check them. They have put out posts that, this is what I'm putting, and this is how it's going to look like next year in the 2 quarters. This is how it's going to look, and they give their logic, and you can check that with the price. And you've realized that there are people who are really good. Sometimes they are ex-insiders. They know the company so well. So I'm not saying you trust them fully, but still it gives you the track record. I would say is not a guarantee of the future, but it tells you about the process that people follow, right? So on the basis that you correct your valuation, and that's when you go and develop. At the end, you develop a portfolio. Now, portfolio development is again, it is a function of how much risk you want to take. It's not for the faint-hearted. So if you are fine with taking a lot of risk, then you go for the risky stocks. But then if you want to have it a balanced portfolio look, then you go for the low risk, low return, or stable return stocks, right? And all that plays out. So this is, in nutshell, is how the investment process top-down looks like. Now, it can be called bottom-up, in which you actually go straight to the third step, right? Where you don't really look at the asset allocation, you go by the ear, right? You pick that particular property or asset that you are interested in, that particular company that you're interested in, you go straight to that company. You don't do, and a lot of people I see, millennials especially, they go straight towards a security selection, right? And a lot of the time, the valuation part of the security analysis part, that's not really happening. Now, this security analysis part could be technical or fundamental, as we said many times, but the valuation essentially, I would say, would have to come from fundamental analysis if we are looking for investment, right? So that's my 2 cents about the investment process, the simple investment process. You may find it very, very basic, but this is what I thought can get a lot of us up to the speed. And if later on, if you want something about the valuation, I would put out a video, would be building up this. So if you're interested, don't worry, we'll be keep on uploading videos long after this course is over. All right, so I'll see you in the next video.